It is Thursday night, August 9th, and I'm going to update a couple markets here, the stock market and the gold market. What I'm going to do is start with the longer term view tonight to put some things in context. I think it's helpful to put things in context first as we're narrowing down on a possible reversal type of pattern here. So let's start with the longer view. This is an S&P 500 monthly time frame chart, so each one of these candlesticks is 1 month, and this is a stochastic study down here. And I've shown this before. The stochastics is overbought. It has been overbought for a few months. It did turn down this spring, but as of this month, it has crossed back up into a buy signal, which should be respected in that it crossed back up to a buy signal. However, if you look back at these prior bull market tops, we did see some very brief crosses up into a buy signal right as the market was chopping around its top. We saw that happen back around the 2000 top too. You had a couple of these buy signals there. So I don't necessarily think we need to take that as too bullish of a signal, but again, that's just added confirmation to the idea that if the June low, this June's low does not hold, that would indicate some very significant weakness in the market. We'll probably see some follow-through selling on a break to new lows for the year. Now, to put it in some further context, I'm going to click over to a quarterly chart. So each one of these candlesticks is now 3 months or a quarter. We can also see that the quarterly chart is overbought. So it was oversold down here around the bear market lows from 2009 and has come all the way back up to overbought territory. So that's a pretty long time frame. If you click over even the yearly, this is each one of these bars is a year. There was a bearish divergence at the 2007 high relative to the 2000 high on the stochastics here. And again, we've crossed back up into a buy signal on that yearly chart. Basically just showing this chart to show that on a long-term basis we still have not even come back below that 50 line on the yearly chart. This may be part of a longer-term type of a corrective action. I'm going to click down to a weekly time frame. This is a weekly RSI study there, coming up against trendline resistance in the RSI. This is a weekly stochastic showing that the stochastics is now overbought on a weekly time frame. So we have monthly overbought and we have weekly overbought. I showed the Bollinger Bands a couple weeks ago. This is as perfectly tight and parallel a Bollinger Band channel as you'll ever see there. Top and bottom just perfectly channeling there. So what to watch for on the Bollinger Bands is as the price approaches one of the bands, you want to watch for what the bands do. If they both expand, that indicates that volatility is increasing, and it may lead to an explosive move, but not necessarily a stable or long trending type of move. If the bands both turn in the same direction, up or down, that would be more indicative of a stable trending type of move. So those are what to look for here. We are getting close to that upper Bollinger Band. I don't necessarily expect the market to touch up there, but that's something to keep an eye on. Click down to a daily chart, and what I'm showing here, this is an ADX study down here. So ADX stands for the Directional Index, and it measures trending activity. So when the ADX study is below 20, that indicates the market is not in a trending type of a mode. And when the ADX is falling, that indicates that the market is also not trending, or it's starting to behave more like a range instead of a trend. So we had a trend, we had the ADX rising as price fell into June, and then we've had the ADX fall as price has risen since then, and it's currently hovering at a very low level. So the next thing to watch for, which will tend to lead to some significant follow-through or more stable trending type of moves, is watch for the ADX to turn above 20, and whatever direction price is going when that crosses above 20, that's most likely the direction of the new trend. So that's something to keep an eye on here. Now, I had mentioned that the market may be near an area of a pattern completion on a longer term basis. And let me click down to a different chart here. So this is the SPY ETF, so still the S&P 500. And this is RSI study here. It's basically very close to overbought at 70, so it's up at around 68 as of the close today. So close to overbought on a daily time frame on the RSI, which a lot of times that gives pretty good signals in a range-bound market. Can give very excellent signals there. What I'm showing here as far as the pattern is after this downward move in 2011, this upward move retraced this move down in less time than it took to form this down move in September. So it indicated that a new pattern up started at the October low. And what I believe we have being the case since then is an A, B, C, D, E type of pattern, at least based off of the price logic. And let me click over to the New York Stock Exchange chart to show that. So it'd be like an A, B, C, D, E type of pattern here. And what should happen here is if this is indeed that type of a pattern and the pattern is completing at these levels, we should see at a minimum, to confirm that, a larger and faster move than any counter trend move within this pattern itself. So this was the larger of those downward moves there, so we could project that down from the high. And then typically even you will see the market, if we even take just the fastest portion of that decline there, which is right here, once the pattern truly completes, you'll typically then see a move that is larger and faster than any intra-pattern, the largest and fastest move within the pattern. So it just shows you that we could be set for a very explosive downward move lasting a few weeks or longer once this pattern completes, and it looks like we may be completing very soon here. Now, on a longer term basis, what I have shown is that I believe that the whole pattern up either from the 2009 lows, or I would actually consider the upward pattern to start from the July 2009 low, but in any case, I actually believe this whole pattern up would be an A, B, C, D, E pattern, and a triangular basically type of a pattern. I know it is not necessarily shaped like a triangle, though if you draw the trend lines going backwards, it does get shaped like a triangle there. But it's not uncommon for a triangular type of pattern to end with, as the final wave of it, another smaller triangular pattern. So that fits in context with a larger pattern, and the point of showing this chart is that if right here we are truly completing this entire bull market pattern, we should not only see a move that's faster than any of these downward moves within this last leg up, we should actually see a move faster and larger than any move within counter trend move within the pattern. So we really should see a move that is larger than the 2011 correction there, and we may even see a move that is larger and faster than the August decline, so that 3 to 5 week decline last August there. So if you project some of those things down from the highs in the current market, then you can see that that would put us at a pretty significantly low level based off of those projections. So those would put us down back near the November or October lows in just a few weeks time frame. Now, narrowing on down into the pattern here, I showed this chart on within the last couple weeks here, and projected that the top. I laid out this green box here a couple weeks ago and said that I believe the ideal time for the current move up to end, based on both price and time, would actually be at the top right corner of this green box there. We almost exactly touched that today, maybe coincidentally, maybe not. However, there are some sub patterns here and some harmonic patterns and things that really indicate to me that this may be a topping time frame here. So that's something to respect as far as the pattern of the market there. Now, clicking down to a hourly time frame, I've been tracking this development up from the June 28th advance as the beginning of an upward pattern here. Have this labeled as an ABC with a X wave and then an ABC with an X wave. The market has made a higher high relative to July 30th there. However, the technical indicators, like in this case the MACD down here, has not. So we have a pretty strong bearish divergence at this high, which is indicative of the type of patterns you see at trend changes or the end of patterns there. So that's some further evidence that we maybe see some topping here. And then this red box is the area that I had laid out the most, what I believe is the most likely topping, specific topping time frame for this move up since last week, and that is based off of the this prior legs A and B that I have labeled here. Now, what this represents here, these two lines, is once we are done with a pattern, the confirmation that a pattern did complete or that a trend is actually changing is for the market to completely retrace the last leg of that pattern in less time than it took to form. So from this low to this high here, it took almost exactly a week. So let's just say we top today, then the market would need to be back below the S&P 500, or the SPY would need to be back below about 135.50 by Thursday next week to confirm, logically confirm a pattern shift. So that in and of itself is a pretty dynamic move, but given the longer term context, that may be just the beginning of what could be a major, I hate overusing the word crash, but a major type of a vertical decline in the market. Now, I did also mention just, I believe yesterday on a post in relative to the volume this week that this is New York Stock Exchange, but I looked through some different ETFs and composite volumes on the S&P 500 and Dow and things like that, and they were basically more or less identical. But I'm going to scroll in here a little bit closer. This day here, so August 6th and August 8th, which were Monday and Wednesday, were very low volume days on the exchanges. Now, looking back here, you might say, well, I see some days that are lower than that. But let me zoom out here. If you look back a few years, really the only days that are registering lower than this week are only holiday trade, which we have to discount because we are currently not in a holiday environment, so you do have to kind of rule those out. But today we saw the lowest volume in a couple years, and I'm going to show you that. So on the New York Stock Exchange today, we had volume fall significantly from an already low level. And going back through this line right here represents the peak of today's volume. This here was the July 4th holiday volume. That's why that's lower. This was Memorial Day trade, and that's still higher than today's volume. So you have to kind of discount those. This was Christmas, which you have to discount. This was Thanksgiving, which you have to discount. And then you can go back in the entire following year. All of the volume days were above that line. This is the Christmas 2010, New Year's 2011. This is the corresponding Thanksgiving, and all the way back into August of 2010. So we're going on over 2 years. Today's trade was the lowest non-holiday volume in 2 years, and we've had basically the 3 lowest volume trading days of the last 2 years all occurring this week. Now, question is, what does that mean? So we can objectively see that happened, but what does that mean? Well, it absolutely objectively means that the large players, the institutional money, the big money is not active right here. They're not exchanging and trading. What I believe is the most likely interpretation of that is that, and I probably showed this before on the blog several times, but very, very low volume as a market is rising or hitting highs has bearish implications. There is waning demand from the institutions. There's not a lot of activity. That's typically a sign that that market is running out of steam and is going to pull back. And I think that's the case here, and it's especially notable in that we had a couple big up days. We had the big move up after the FOMC move, the FOMC meeting here within the last week or so. We had the unemployment report on Friday. The market took a big gap up. We had some news that the FOMC was going to extend some of its bailout package type of through the end of this year. We had another big move the prior Friday, and on some bailout news from Europe. So we've had some news events. We've had an FOMC meeting. We've had the market, push slightly above these highs, and then we see the 3 lowest volume trading days in over 2 years. I think that truly means that there is just no interest in the big money at buy in this market. It is not progressing after this breakout. So I think that is a big, big red flag for the bullish case here. There are a whole ton of indicators showing some divergence here. I am going to go through a few of those. I don't want this video to take forever, but I think this could legitimately we could be peaking here at one of the fastest declines in the history of the stock market in years. So I do want to make sure I go through some of this stuff so that anybody who follows this has everything they need to know to make a decision on their trading or their investing here. This is a chart of Apple. One thing I wanted to point out is that for anybody who's studied the Investor's Business Daily type of methodologies, as far as growth stocks and patterns and breakout patterns, this may be interpreted either as a cup with a handle pattern here or a double bottom base pattern with a handle here. And this green line right here represents the top of the handle, which would be the buy point on those patterns. And what we saw is on Monday, Apple moved up past that buy point, and there has been no follow through since then. And what I'm going to do is quickly show the volume here on Apple to show that the move up on Monday was on decreased volume from the prior day. It was on below 50-day average volume, and the volume has successively fallen since then. So what should happen when the price of a growth stock like this hits the buy point of a basing pattern is you should see volume pick up, oftentimes dramatically so, and you should see price initially zoom up and break out above that resistance level. It's not uncommon for after it breaks out to come back down and retest that as support, but we have seen nothing here. I think this is just another big red flag that Apple is running out of steam. This may be a failed basing pattern here. If so, we will probably see Apple rapidly decline back down to this 520 level, and it should be likely correcting the whole entire bull market from 2009. So we may see a pretty drastic haircut in Apple. 30% or more, or excuse me, 50% or more would not be at all unreasonable as far as that goes. So those are just some of the big warning flags I wanted to point out here as far as what's going on with the market topping. Now, what I want to do is show some of the divergences showing up in the market indicators here. So we're getting some confirmation from sentiment and breadth that this rally is running out of steam. This is the total put-call volume ratio, and currently it's trading back down into some relatively low levels that have corresponded with prior highs in the market. So this would be the low levels here from this past spring before the market topped out and corrected. This would be going back to April 2011, before the market really fell hard into August 2011. And on a relative basis, the put-call ratios are very much lower over the last week than they have been over the last quarter. So this type of data tends to revert to a mean of approximately 0. So any type of movement of this line well above or below 0 would be an indication that the market has likely gone too far in one direction and will correct. So in this case, the market has risen, the put-call ratios have fallen. We're likely to see a correction soon. This is the tick, which is a measure of breadth. It has not made a new 5-day average high relative to the early July, so we're having some breadth divergence show up there. This is the McClellan oscillator. This is probably the most telling one. This is the early July peak, and this is current. That is just a monster bearish divergence in the breadth here. Whenever you see divergences that steep in these indicators, the declines to follow are typically pretty healthy there. There's several other things we could go through there, but price is showing divergence, breadth is showing divergence, put-call ratios or sentiment is actually showing divergence. One thing I don't have data to show here, but the since June, the sentiment surveys of both investment advisors and individuals have not really made a significant advance, which some are interpreting that as the fear has not left the market, and so there's this wall of worry to climb. However, my personal belief at this point in time is, given all the other stuff I just went over, is I actually view that as a massive and very powerful bearish divergence, in that we did see sentiment get excessively bullish this past winter and spring as the market rallied. But even though the market is essentially very close back up to those highs, the sentiment has not come back close to that level. And that shows me basically that the underlying market sentiment is getting more and more bearish, and you're going to see those type of things at trend changes. Those are very common patterns at trend changes. It's just kind of, I think, a little bit tricky here, because it has barely risen at all, and it seems almost like the sentiment readings are low, like there's a lot of fear in the market. So time will tell on that, but that would be my interpretation of that based off of that data. Now, what I want to show next is gold, because I think there's an absolutely enormous move coming up in gold. I think it's going to be to the downside, and I think we're getting closer every day on that taking place. I had recently shown what I believe is a symmetrical triangle, and had mentioned that gold did seem to break out of that. So I had trend lines drawn like this, based off of this high, this low, and this low. And gold did break out of that for a couple of days. However, what I said on the blog was any type of move back into the into the triangle would make a suspect breakout, and we did see that a couple of days later. So what I have done is redrawn this at that high. Continues to look like a symmetrical triangle, which may still have a D and an E wave to form before it breaks out, but I would look for this to break to the downside. One point of note here, and let me click over to the continuous gold chart. This pale red line here is a point of repetitive support and resistance looking back. So we had the market high here, 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 all find resistance at that level. We had the market lows here, here, and here, all find resistance at that level. We had the rebound of this level, find resistance. We had this decline, find resistance there. And while I'm not showing this here, but if you look at, for instance, if you look at the GLD ETF, there's an indicator you can look at called volume by price, and it shows you at which level on the chart, what price levels say 160, 165, 170, and so on, which of those levels has most of the volume traded in over X amount of time. And the heavy volume area is right in this area here, where this consolidation was this area, this consolidation here. So the market is poking right back up into the area of the most heavy volume of trade, and so it is bumping into resistance. So I think what we need to do is we need to watch for a breakout above that resistance level. If you, for a bullish case scenario, what I would suggest is that this past reporting period, the commitment of traders data, which is the smart money commercial traders who know the fundamentals better than anybody else, this was the reporting period after the bailout news a couple weeks ago. Commercials sold somewhat heavily, not dramatically so, but had a pretty heavy sell that week in both gold and silver. So despite this headline news that the European Central Bank is going to step in, they're going to stimulate, they're going to do what they always do, and you would tend to think that's inflationary or would be bullish for gold, the commercials actually ramped up their selling on that news, and that is with the market right at a resistance level. So I think that's another added kind of psychology component, that the big money here is not ready for a breakout, but we just need to watch the price level to confirm that. Now, additionally, one I wanted to show here is, partially because this is such a powerful setup, and I've talked about these a number of times on the blog over the last couple years here, but this is an ADX study, and again, that shows trending or activity or non-trending activity. If you scroll back here, the ADX is very, very low. It's putting in a reading of 9, which is the lowest reading in a couple years, and it has been very low for a couple months now as gold has consolidated. So it shows that the market is going through a basing or a non-trending period. Lengthy periods of that happening, in my studies of studying this indicator, when that happens for a month or more, that ADX is below 20 consecutively for a month, especially if it's still falling like that, that is a very large basing period. It's going to set up typically a very, very strong, powerful move on the next breakout. So the question is, what is that going to be? Now, here's how my suggestion on how to answer that, and even possibly how to trade that or trade options on that, is the Bollinger Bands have squeezed relatively tightly here. What will tend to happen in this setup is whichever the next close outside the Bollinger Bands are, if the Bollinger Bands expand, meaning the top one goes up and the bottom one goes down when the market has closed outside the band. So let's just say the market follows what I think it's going to do, which is have a downside breakout. So let's say the market comes down here and closes below the lower Bollinger Band, and that band is expanding, and the top one is expanding. There can be just some massive vertical type of moves that can happen, though they may be very quick after that happens. But based off of the projections I've shown in gold, we could easily see a move, I think, down to the 1200 area on gold. Let me show that on the weekly chart. So we can easily see him move down to this maybe 1230 level or so on gold, if there is a downside breakout of this pattern here. So that's just some indicators to watch, and possibly how to initiate a trade on that. Then the question is how to exit that. I'll update as those type of patterns unfold there, but that's what I'm looking at on gold here. So I hope that's helpful. I already covered bonds in some detail last week, but I believe on an investment basis this is a time to be long the US dollar on an investment basis and basically out of everything else. However, there are inverse ETFs and things like that you can use to short some of these markets. I think there's going to be some incredible profit opportunities, but you have to know how to do that and how to control risk doing that. So if somebody has little to no trading experience on that, probably not something you should consider or mess with there. But just sit in cash, wait for things to play out a bit, and then look to reinvest down the road. So that's all for this update. Have a great weekend. I don't think I will get another post up this weekend. Hopefully next week we'll get another post, and we'll have seen the market kind of confirm to us what its next move is.